Hi everyone, welcome to today's video. So many a times you would have heard the argument that if a good business or good industry is facing temporary problems, then you are going to get a lot of those stocks at a massive discount. You must buy those stocks and hold it, and these temporary problems will get solved, and whatever stocks you have purchased, they will somewhat give you massive returns. So this is a very commonsensical way of making investment, and all the major investors use this value investing method to make returns in the stock market. Now something very similar is happening in the entire tech domain, that many of the tech stocks right now are deeply undervalued. Why? Because there is a temporary problem at play. What is this problem? So that problem is playing right in front of our eyes, that many people are losing job in tech. They are getting fired. Almost all the major companies in the US are undertaking massive firing. Similarly, a lot of tech-oriented startups in India are firing people. Similarly, a lot of publicly listed tech companies in India that got recent IPO listings, they have started firing people and their stock price has also tanked. So if you feel that this job problem is a temporary problem and it will get solved with time, then it might be a great time to build your tech portfolio. So on this video, I'm going to discuss multiple tech stocks, both from India and the US, and I'm going to present my viewpoint on it. I'm building positions on many of these stocks and I'm avoiding many of these stocks that I'm going to talk about. In case you want to check which are some of these stocks in which I'm building my positions in, you can check the links in the description box. And on this video, I'm going to further help you understand what other tech stocks I'm going to purchase and avoid. So let us quickly kickstart our discussion. And before jumping there, I understand that many people might be struggling in terms of their jobs because there has been so much firing. So in case you want to prepare yourself better for a tech-oriented job market, you can check out Coding Invaders, who are the sponsors of today's video. Coding Invaders help people from non-tech background to migrate into data analytics type of jobs. These type of jobs are quite good from a package point of view. The amount of training required is also low and you can train yourself between 6 to 8 months. Coding Invaders can help you with this prep, and their courses comes with a money back guarantee that in case you avail their course and are unable to get job placement, then you will get 100% of your money back. Their current placement statistics are 93%, and this is largely driven by the fact that their courses are run by industry professionals, people working with Amazon, Philips, etc. So all these big companies, and they have helped more than 20,000 students get jobs which range between 10 lakh and 25 lakh rupee package over the last 6.5 months. So in case you want to learn more, you can check that link in the description and pinned comment box. Okay, so the first type of tech stock that I want to have a conversation with you about is TCS, Infosys type of companies. Now, is it a good time to buy TCS, Infosys right now? Because I had been purchasing TCS quite aggressively over the last few months when it was trading at around 3,000 levels. That is when I had built a significant amount of my position. Now, am I buying more of it, or should you be buying more of it? To understand this first critical point, you need to take a look at where the entire IT industry is currently standing in India. So from this technical chart, you can see, and this is for Nifty IT index, you can categorically see that the index itself is trading at a 26% discount from its peak. Now, do I see this particular index going back right at its top within no time? The short answer is no. I don't see that happening. I do see that happening when we transition from this journey of 17,600 to 21,500. Yes, when we start hitting the top end of this line, that is where the recovery of the entire IT sector will happen. Now, why am I saying it? The reason is fairly simple, that between the time period 2020 and 2021, the IT stocks gave a major run up. A lot of inflation of those stocks has already happened. They became grossly overvalued. While no one can predict when the complete recovery of this would happen, it might very well happen in 1 week. I don't know. But my estimate is that this is going to take some time. This is most likely going to get completed somewhere in 2024. Why am I saying this date? You will understand the answer and I will reveal it somewhere along the video. So the bottom line is that between the time period 2020 and 2021, IT stocks became grossly overvalued. Then there came a major dip when there was massive correction going on in US stocks. Europe problem was happening, etc., etc. So the stocks came down quite aggressively. Now they have started to inch back up, and there is a very high likelihood from a technicals viewpoint that the stocks are going to trade in this range all the way to this range for the next 2 years. So this is my estimate. Of course, I can be wrong, but I'm telling you this simply because of the fact that because if you see the Nifty IT trading in this zone, in this lower half, that could be a collection zone, and you can build your position keeping in mind that it might take 2.5 years to make the entire recovery. If you're seeing the Nifty IT trading somewhere around here, then it might be cautious. You don't need to buy IT stocks in aggressive mode. So in that technical context, if you start analyzing the TCS's stock, you will see that the stock is down from its peak by 20%. The entire Nifty IT is down by how much? Around 25-26%. TCS, which forms a major part of that IT portfolio, is down slightly less. So a lot of recovery has happened on TCS already. Am I going to buy this stock in bulk somewhere here? The answer is no. This is not a bulk buying opportunity as of now, given the market circumstances. Now I might very well make a updated video in maybe month and a half, and if the market dynamics change, it might very well become a bulk buying opportunity. But as of today, when I'm shooting this video, this is not a bulk buying opportunity on TCS. Now, why am I saying that this is not a bulk buying opportunity? So let me clarify 2-3 things. So number one, TCS is a good business. It's a good company. Number two, it is a less volatile tech stock. Why? Because this is a service-based industry stock and its performance does not depend on ad revenues. For example, when you go and analyze companies like Amazon, Google, Netflix, all these different tech companies, they are majorly dependent on global ad spending. If the global ad spending goes up, then Amazon, Meta, Apple, all these companies benefit. But global ad spending, does it have any impact on TCS? The answer is no, it does not have any material impact on TCS's business. Now, what is it that TCS's business depends on? Well, it depends on the environment in US and EU. Now, the problem is that almost 14-15% of TCS's business comes just from UK. I'm not saying Europe, I'm saying UK. And you can see the split here that 15% of revenue for TCS is coming from UK. This is a major problem because right now US seems to be undergoing a crisis. And if there is a debt bubble that is going to burst somewhere in the world, the most likelihood stands in Europe. Now, there is a video that I had done on UK's economy. Please go and watch it. I had explained that what precisely is wrong with the UK's economy right now and why it has been struggling. There is no respite in sight right now in the UK. Their Brexit has caused multiple issues. Their poor monetary management has caused multiple issues, and bunch of other problems are happening. So the recovery in the UK is unlikely to happen at least for a substantial future, which is a major red flag for companies like TCS. Now, this has been captured by TCS's management also. So here you can pause the video and read through the commentary, but the interesting line here is Europe is a very uncertain environment for us right now. This is a major red flag, which even the management at TCS is acknowledged. Now, let me show you 2-3 more data points that one of the key areas in which companies like TCS or Infosys can grow is that they are very well diversified businesses and they can move a large chunk of their business from, let's say, banking to healthcare, which is a growing industry as of now. Because what is TCS Infosys doing? They are basically providing back-end tech support. Now, will they be able to do it? I have no data to prove or disprove that theory. But one area where we can delve deeper and look into TCS model is that where their major clients are. So this is the list of clients that they have. And what you would notice is that in the US, where a large chunk of its business comes from, that they have almost all the top 10 retail clients. Now, if you go and study the financials of big retail companies in the US right now, it doesn't look very promising. For example, this is the books of Walmart, and you can see that their growth rate has been really slow. There is nothing to boast about. It's a very slow snail-like growth rate, which is not very exciting. And what that indirectly means is that it's not as if that they are going to expand aggressively and give TCS more business. So again, this is not positive news because UK is already witnessing problem, which will have spillover effects on EU, and even within the US, their client segment is not going to spend crazy amount of money. So there is no trigger growth prospects that is likely to happen with TCS. But yes, many a time I get the comment that Akshat, you are changing your commentary on TCS. No, I'm changing my commentary on TCS because right now TCS is trading at a slightly higher price. I was very pro TCS when it was trading at 3,000 rupee and I was aggregating it. Right now it has become slightly moderate. If you are keeping a 2-3 year viewpoint, it is okay to aggregate it. There is no fundamental issue with the stock. The macro environment, at least in the US, is likely to become very favorable from next year onwards. So that is going to lead to slightly better growth. But definitely this is not the time to bulk buy companies like TCS or Infosys. Now comes the natural question that, okay, what about their younger brothers, for example, Mindtree and Wipro? So I had made a separate video on Wipro. So please go and watch it, but I'll give you very quick commentary on Wipro and Mindtree. So now if you quickly study the technicals, what you will notice in Wipro's case is that the fall in the stock price has been minus 50% almost. This is a significant fall in the stock price because one of the key hypotheses here is that TCS is also entering into areas where Wipro is active. TCS, because it is not getting frontline business, it is trying to expand very aggressively. Now, this commentary can be well understood by looking at the recent merger that has been announced of L&T Infotech and Mindtree. So this is a very important snippet and I will read it out. So basically the snippet says that large IT outsourcing firms are expanding into areas such as cyber security, automation, machine learning, moving beyond low margin traditional back-end room services. So basically, to cut the long story short, all these different companies, TCS, Infosys, Wipro, etc., they are all trying to put their fingers in different geeky handi. So basically they are just looking for growth opportunities, and wherever they can figure out growth opportunities, they have no problem going there and they are experimenting. They are all in experiment mode. Good thing about TCS Infosys vis-a-vis Wipro Mindtree is that TCS Infosys actually has the money and R&D capabilities to enter into these new growth areas fairly quickly. Now, in case of Mindtree, it's not as if that the business model is going to suffer a lot, but the recent news of merger that has derailed the share both for L&T Infotech and Mindtree both. So therefore, I would say that it is available at a slightly discounted price. But I'm not an investor in Mindtree. I'm simply trying to say that from a pricing point of view, Mindtree looks okay, but from a fundamental point of view, if you want to fundamentally hold the stock, then I don't know in which area they will be able to successfully expand, because L&T itself does not have a very good innovation history. So let's move on to the next set of stocks. So I have gotten a lot of comments that can you please talk about PB Fintech. So I'm going to talk about PB Fintech and Zomato, and I'm going to compare both these stocks. So first and foremost, what PB Fintech does, so they run Policy Bazaar and a bunch of other different platforms. They are into insurance selling and financial product selling plus consulting. So here is the revenue split and you can see how the firm makes money. Now, the important point to note from PB Fintech's business model is fairly simple, that this is not a sticky business. Now, what is meant by sticky business? For example, if you consider Zomato and if you get into the habit of ordering food from Zomato, Swiggy, then रात को 11 बज रहे हैं, right? You will go and order food. Okay, burger खाना है, तो you will go and order food from Zomato, even if you can make it at home. Why? Because we prefer convenience. अब कौन उठेगा फ्रिज से आलू निकालेगा, बॉईल करेगा, उसमें फिर बर्गर बनाएगा, and then they will put it in bun, this, that, right? So you are not going to get into that hassle. You might have formed a bad habit that 11:30, I am feeling hungry, I'll order from Zomato. So people keep on doing that stuff. So these become sticky customer for a particular app. So the customer switching is very difficult because Zomato, Swiggy are habit forming businesses. But is PB Infotech / Policy Bazaar, is it a habit forming business? No, it's not as if that रात को 11 बज रहे हैं, I feel like buying insurance. Then you will go and start searching like a maniac person. No, you will actually go and research it thoroughly. You might speak with 10, 15, 20 different people. So then finally you will make the call that is most sensible. So this is a research oriented product. There is no customer stickiness when it comes to buying insurance products online. Just because you hear the word Policy Bazaar does not mean that you are going to get swayed by it. They do a lot of push based marketing, which is clearly not working out for them. So here are the company financials and you can categorically see that as the sales have gone up, so have the losses. Now, why does this happen? This is such a tried and tested story that startups end up burning crazy amount of money doing marketing, and that is precisely what PB Fintech is also doing. That they are able to generate revenues by how? Not through word of mouth, but by brutal advertising. And this is a really bad business model. Now, you might say that, you know what, the stock has already fallen by 70%. So should I go and buy it? Ab kya hi bura hoga stock ke saath? Now, I don't know, because if you are trying to hold this stock for 2-3 years and if it falls by another 15-20%, then I would not have the confidence to hold this stock further. Why am I saying it? Because the founder himself does not have the confidence of holding the stock. And he gave some really funny commentary as to why did he sell his own stock. So basically, he was asked in a press conference that you trimmed your stake by almost 0.82%. And we saw the stock coming down under so much pressure. So he started saying that, you know what, this is my only job. I need car, I need money, all my money is stuck with the company. So I need to make some money. And I did that by selling my stock. So guess what? When did he sell that stock? He sold that stock somewhere in June, July. That was the period when the stock was trading at roughly 700 rupees. Now it is trading below 300 rupees. So basically he sold the stock and the stock has further came down by 50% from that point. So this definitely does not generate any confidence. He was further asked that do you not care about the stock price falling, etc., etc. He said, I don't understand stock market. I've never invested in stocks. Okay, then why did you come to the stock market and got your company listed and sold your own stocks? I'm not trying to make personal digs. I'm nothing in front of him. I'm simply talking from an investment point of view that to me as an investor, it just looks really funny commentary. So between between PB Fintech and Zomato right now, if I have to pick one, I would definitely pick Zomato. This is a 0 to 1 type of bet. 0 to 1 simply means that if you invest, let's say 1,000 rupees, then most likely this stock is either going to become, let's say, a 5,000 rupee, or it is going to go to like 500 rupees. So that's the risk reward equation that you need to analyze both on Zomato and PB Fintech type of companies. So you make a call where you want to put your money. I had already put my money on Zomato when it was going very negative talks. Zomato since then has given massive bounce up. Again, not a push from my side to put more money on Zomato, this, that, nothing of that sort. I'm genuinely talking about whatever I'm doing in the market, because many a times when I talk about aggressive companies, people just take it as toxic commentary. So please avoid investment whichever you don't feel comfortable with, and follow the ones that make sense for you as per your portfolio. My job is to talk about whatever I'm doing. This is not a recommendation from my side. These are simply research oriented points. So now comes the natural question that what about mega companies? For example, Microsoft, Amazon, Meta, all these companies, stock price has gotten crushed quite a lot. For example, if you check Amazon, then it has fallen by roughly 23% in almost a month. So does it make sense to buy something like Amazon? My short answer would be a yes, that even now there is a good buying opportunity in something like Amazon, and let me help you understand why. So we started today's video by talking about a fundamental issue that is happening in the tech industry, which is massive layoff. And that is the reason why Facebook / Meta, Amazon, Google all are getting a little bit of heat in the market. Now, is this a permanent problem? The short answer is no. So take a look at this graphic, and what you will notice is that Amazon right now is a massively profitable company. Same goes for Meta. There has been so much talk done on Meta that you know what, their daily average users are going down. They have almost 2-point-something billion people as their daily average users. Almost 30 to 40% of the world's population, it ends up using Meta's product on a daily basis. They have no problem in terms of burning their R&D money, hiring best possible engineers, etc., etc. So if you are a little bit patient about these companies, they are likely to give you very good results. So then comes the natural response that, okay, then why is it that Amazon, Meta, all these companies are suffering right now? I understand the viewpoint that people getting fired, bad sentiments in the market, people making LinkedIn posts. But why is it that these companies are suffering on the stock market? Well, there are much deeper reasons at play. The first and foremost reason there is the raising of capital. For example, back in 2017, 18, 19, and even the early half of 2020, debt was cheap. Now, what is meant by debt was cheap? If you take a look at the interest rate, you can check the graphic here. We were close to 0% interest rate in the US. Now, what did that mean? It simply meant that companies like Amazon, Apple, they were all raising money like crazy on debt financing, taking loans at really cheap prices. Now, since 2021 and in the early half of 2022, debt has become very, very expensive. So therefore, the companies are not raising money via the debt market, and they have put their expansion plans on hold. That is the simple thing. This is not a negative news that you know what, companies are not expanding. They will expand whenever the money becomes cheap. So right now money is expensive. So they are just holding off, which they will deploy when the money becomes cheap. Right now money itself is very expensive. So they will just simply go and invest that money and make that money. So therefore they don't require that big a workforce. Second key problem, because the interest rates have risen so much, what has ended up happening is that the advertising revenues has gone down. Why has it gone down? Because think about it this way, which companies spend the most on advertising? Hint, it's pre-IPO type of companies, Byju's, etc., etc. And they spend crazy amount of money, probably on Facebook marketing, Google marketing, etc., etc. So the total ad spent in the world has come down, and as a result, all the other different companies, Meta, Google, this, that, they are suffering because of this shrinkage in the ad revenues. Now, third and final point can be understood from this chart, which shows the rate at which hiring is done at major tech companies. So you will see this rate to be roughly 15%. For example, check the graphic between 2018 and 2019. There was a 15% hiring rate increase. But between 2019 and 2020, when the pandemic hit, all the people started tying themselves at home. At what rate did the hiring increase? It grew by almost 35-40%. Now there has been a buffer that has been created, which is letting go. And that is precisely the reason why Amazon, Meta are firing 15 to 20% of their workforce. So to cut the long story short, there is no fundamental change in the business model when it comes to Meta, Amazon, etc., etc. They are all good stocks even as of now. If you're considering little bit of bulk buying, it is also a decent opportunity right now. Why? Because the sentiments are really, really bad as of now. Continue to build your position over the next 4 to 5, 6 months. So you could consider bulk buying these stocks whenever the opportunity presents itself over the next 6 months, because that is the period in which the unemployment will peak, and whenever any positive news comes out for the overall broad stock market, tech stocks are going to run the most. And in my opinion, companies like Amazon, Meta, all these companies are going to exhibit aggressive growth. Okay, so now let's talk about final two stocks. Okay, so let's first talk about Tesla. So I have not built any position on Tesla as of now, but I am very close to building it. So I will reanalyze this stock and buy it from time to time. Fundamentally, it's a very good stock. It is available at almost 60% discount from its peak right now. I still feel that the valuation are slightly rich, not because of some intrinsic value issue, but because of the fact that the EV story has not still been proven yet across multiple markets. And China is a missing story from Tesla's growth as of now. There has been a lot of hoopla going on in China. So I will investigate that angle and I will try to build my position in Tesla into that. Because if it is clear that Tesla has a very clear growth path in China, then I have no trouble taking positions in Tesla stock. So that is the precise piece of information I am trying to sort out, and as soon as I'm able to fill that information void in, I will build some position on Tesla. Final stock is Coinbase. So Coinbase has fallen almost by 86%. Why is it? Because cryptos this year have been the most negative asset, so to say. You have already seen my commentary on it, which I had shot on yesterday's video. You can go and check it out. Very, very important video. Coinbase's performance is directly linked to cryptos. Now with regulation or crypto regulations coming in, exchanges like Binance, Coinbase are going to become aggressively regulated. By the way, Coinbase is already regulated in the US. It's a listed exchange in which even the stock market investors can put your money. Going forward, there will be very few exchanges or crypto exchanges left in the world. Coinbase, Binance seems like the two most favorable ones. And by regulating this, what will happen? What is that number one change that will happen? Well, the governments will start making money on cryptos. This is the problem that they have had with cryptos primarily. Because think about it, that government makes money from alcohol, government makes money from betting, gambling, government makes money from tobacco. All these supermarket products, almost 99% of the supermarket products are chemically infused. That food is not fit even for animals. Forget about feeding it to humans. But humans are fed that because governments make crazy amount of money and they allow these type of chemicals to be put. So please don't consider that government would not allow cryptos in case they see an opportunity for themselves to make money. So from that perspective, with the regulation setting in, it is very clear that government will figure out a way to make money from crypto trading, etc., etc. There is a very clear path to money making by the government in the crypto space also, and very soon it will find mass adoption. So again, if you're looking for a 0 to 1 type of bet, then Coinbase becomes a good stock. I know that I'll take a lot of heat for saying this, but when I say 0 to 1 type of companies, it simply means that these are highly volatile companies. So as an end disclaimer, what I would like to simply tell you is that investing in tech is itself very risky. If you're picking small tech companies, it becomes riskier. If you are picking 0 to 1 type of companies, it becomes the riskiest. So please take assets as per your understanding, as per your risk appetite. Also learn how to build positions. It's not as if that, you know what, some stock is trading at a discount of 50%, time to sell my house. So you sell your house, all the money goes into that stock the next day. That is not called as building position, that is called as foolishness. So I hope you enjoyed the video. Do press the like button and I will see you soon.